The second way we categorize mutual funds beyond how they're bought and sold is the portfolio decisions. Are they actively managed or are they passive, which are also known as index funds? And this is a fairly simple distinction. There exists an index. The fund declares that it will track that index by owning all or most of the securities, stocks, or bonds within that index. If it is a passive fund, an equity index or a bond index, it charges very low fees relatively. And if it's an active fund, meaning it's going to buy securities within a specific designation that we'll talk about and try to earn as much as possible, then it's going to charge a higher fee, both management annual fees and possibly a fee to get in or out, called a load, that we'll get to. But these are the two different ways we designate funds in terms of the portfolio decisions. They are active or they are passive, and a synonym for passive is index. Okay, let's talk about the assets held by mutual funds, and we're going to start with money market mutual funds. And we've spent some time talking about money market instruments in the last chapter, and so we're going to talk about the funds that actually hold these instruments. Money market mutual fund only hold very, very short term, very, very low risk, very high liquidity money market securities. And there are three broad types of money market mutual funds. The first is sort of a general fund, and it has a mix of all the different money market instruments, including those issued by the government and those issued by banks and those issued by corporations. The second kind are only government, and they only hold T-bills. They will not hold bank debt, and they will not hold corporate debt. They only hold T-bills. And the third kind are smaller. These only hold very, very short-term instruments issued by municipalities. And we didn't spend a lot of time on this. We talked about muni bonds, but municipalities will often issue, again, the very best credit-rated ones will issue very, very short-term money market type securities, and sometimes they'll issue things in anticipation of a tax revenue date. And so property taxes are paid once or twice a year, and so an entity might issue a very, very short-term money market type security in order to get money ahead of this tax day. And these securities would be bought by a tax-free or municipal money market mutual fund. And these are smaller. You have to have sort of enough activity to make it so that there's enough of these instruments issued so that people can buy them. So not every state has tax-free money market mutual funds offered by every single firm. So if I go to Fidelity, Fidelity is going to offer a California tax-free and a New York tax-free, but maybe not a Montana tax-free, for example. So general and government are the big two. And remember, general own all issues, government own only T-bills. And we'll see why this is important in a minute. Money market mutual funds are special. They never lose money. They only buy the best paper, and they only earn a very, very low return. That's how they do this. Now remember, money market mutual funds did lose money once, and we'll see this break the buck thing below. But in general, money market mutual funds never lose money. They just make a tiny, tiny, tiny bit. And they're special for another reason. The number of shares that the money market mutual fund has issued changes each day such that the NAV is always $1. This is not true for other types of money market mutual funds. Other mutual funds, the NAV changes every day and the number of shares doesn't change unless new shares are bought or redeemed. But the money market mutual fund, they change the denominator based on the value of the equity in the numerator such that the NAV is always equal to 1. Implicit in this is that money market mutual funds are also open-ended funds, that they are buying back and issuing new shares every day, but those shares are always $1. And the way that people earn interest, as it were, is that if, for example, I earn a 1.75% return over the year, and I've invested $10,000, I initially get 10,000 shares each worth $1, and at the end of the year, I have 10,175 shares each worth $1. So every day when new money is earned, new shares are issued. We'll talk briefly about this break the buck. What ended up happening was break the buck refers to the fact that at one particular point in time, the value of the assets actually went down as opposed to up, and remember, they never go down. But at the height of the 2008 liquidity crisis with the failure of Lehman Brothers, no one would lend to any one short term except the US government. Investors only wanted to own T-bills, and so they pulled their money from the general money market funds that we talked about before, and they only put it into the government money market funds. And the way this works is I log on to my Fidelity account, and somewhere there's a drop-down menu that says, what would you like your cash or core account to be? And I had it checked as, well, not personally, but I could have had it checked as general, and I unchecked general and I checked government because I was afraid of lending money to banks, and I was afraid of lending money to corporations. And so what ended up happening was the next morning, the person running the general money market mutual fund had a ton of redemptions, and they had said no more money to buy new stuff. But the person who was running the government money market mutual fund had tons of new money and had to go out and buy new stuff. And so the general money market funds could not buy any new paper because they had to redeem so many shares. And so the issuers of money market securities, the entities that would have sold this new paper to the money market mutual fund, could not roll over their paper. And so they could not sell new debt to pay off the old debt, and this is what created that crisis. And here's an article that sort of describes that. But in general, it is the case that money market mutual funds never lose money, and they do so by only buying very, very, very high quality paper, and so they earn very, very little.